I'm predicting on this channel right here today that the Swiss franc, due to money chasing quality, relative quality, a fiat is not gold in any sense, but relative quality is going to lead to the potential for negative interest rates, particularly on foreign held deposits in the Swiss nation. So watch out for that prediction, see if it comes around. And then owning gold, doesn't matter where, which doesn't charge you a negative interest rate, will actually look like a bargain, and it will outperform the Swiss franc.
Gold stands out from other safe haven assets that are issued by and tied to government owners, industry experts told CNBC. Gold has claimed the safe haven crown. With spot prices surging 30% so far in 2025, bullion's gains are outpacing that of other traditional safe havens such as the Japanese yen, Swiss franc, and US Treasuries, compelling investors to rethink what true safety looks like in the face of fiscal sustainability concerns and looming wars. The forecast corridor of $4,800 to $8,900 depends mainly on how inflationary the next 5 years will be, according to the Gold We Trust Report 2025 by Liechtenstein-based investment firm Incrementum reports. Prominent market analyst FrancisHunt explains Switzerland's zero-rate cut reflects surging safe haven demand. According to FrancisHunt, gold's absence of yield could soon become a key advantage, especially as Switzerland may impose negative rates on foreign-held deposits. He believes this shift would make gold an even more attractive safe haven compared to fiat currencies. Though the dollar and US Treasuries have historically served as a bastion of financial safety, cracks have been starting to show. Based on the current situation, Hunt emphasizes that Switzerland is viewed as a safer credit risk compared to heavily indebted nations, which is why its interest rates have returned to zero. The Swiss National Bank's decision to cut its policy rate to 0% on June 19, 2025, marks a pivotal shift in monetary policy, with profound implications for global markets. This move, the sixth consecutive rate reduction since 2024, aims to counter deflationary pressures and weaken the Swiss franc, which had appreciated over 10% against the US dollar year to date. Furthermore, Hunt analyzes the gold-to-franc chart, calling it a bullish long-term structure despite the current sideways movement. He views recent price action as progress decay, where time elapses without much upward movement, but anticipates another leg higher soon. Before we dive into FrancisHunt's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
What we're actually getting is a polarization of the bad countries, the over-indebted countries, and the semi-serious ones. Now, there's no nation that is a sound money nation, but Switzerland inherently is certainly a lot less bad than Europe, UK, and definitely America as well. And what we're actually seeing is there's a flight to quality. And we had the debt collapse that we called in September 20. You know that now, I keep repeating it, but you had that come down for the better part of 2.5 years. And you've now had a sustained period of dollar weakness where there might be certainly a rally of some form possible. But the other nations like Switzerland, which is semi-serious, we've seen flood of currency into gold. We've seen a flood of currency into the relatively cheap valuations of platinum and silver, although it's not turned in yet to the full-blown run that I think it will. And we're seeing the currency of the Swiss franc because people still need money and they have a choice. High net worth people, treasuries can still choose where to put their currency. And at the moment, it's my express opinion that the West is putting their money in the Swiss franc and potentially even part of the East. And that is why, one of the reasons why, on a weak economy, Switzerland cut. But the difference between Switzerland cutting and everyone else that cut last week is that Switzerland cut to zero. And that's why Zero Hedge came up with their NERP, their ZERP, let me just say, getting my Z's and my N's confused here. The zero interest rate policy is back. Coming to a central bank near you. Wrong. It's back for Switzerland because there is a tsunami of money, liquidity, trying to find safe haven fiat, a safe haven fiat to sit in or an asset that isn't going to be destroyed by the coming debt-based collapse. And that's led to the runs in golds, precious metals, even softs, cocoa and coffee. We've covered those a bit as well, and the Swiss franc. And that's led to the Swiss franc, despite a potential fundamental such as an expected rate cut taking place, we went long in the beginning of June, the 5th and 6th of June, to make hay during this period. And it's been very beneficial. What goes for Switzerland is because as a risk, underwriting risk, perceived risk of reneging on its debt, it is seemed far safer than the other spendthrift nations. That is why you're getting lower rates in Switzerland right the way back down to zero. And, by the way, if it becomes too strong, the franc, it wouldn't shock me that they do go to NERP, minus 0.25, maybe minus 0.5, and actually chew your balance away to stop a financial tsunami of money flooding into the franc and making the franc too strong, killing the Swiss export markets to other nations with weaker currencies. And that is when everybody goes, gold is bad, it pays no yield. That's when not having a certain benefit actually becomes a feature, because gold will never have a negative interest rate that it pays you. And I'm predicting on this channel right here today that the Swiss franc, due to money chasing quality, relative quality, a fiat is not gold in any sense, but relative quality is going to lead to the potential for negative interest rates, particularly on foreign held deposits in the Swiss nation. So watch out for that prediction, see if it comes around. And then owning gold, doesn't matter where, which doesn't charge you a negative interest rate, will actually look like a bargain, and it will outperform the Swiss franc. So let's just test a little bit of that and bring up XAU versus the Swiss franc, because we're throwing a few things at you here and we're making you think cross-purpose, cross-currency, and now we're going to throw the gold at you. Now, gold's a little bit slow at the moment. It's not ripping anywhere, but this is how it's done on the long term. This is where you are. We're on the daily. This is how it's performed. If you have a look at it, by the way, we had two big levels here. A little bit of a grind line here. There's the possibility of a small sell-off, or at least a bit of squaring up for a period now. It's close to highs. You had a beautiful continuation here. You all saw that one. It's not dissimilar to the dollar, just there's more upside in the franc that's made it slightly less of a parabola. A big cluster of targets over here. That's why you got a bit choppy and you've been a little bit of churn post making massive targets. But you cannot argue with the fact that this is an upside based chart. There's those two technical structures, how they came to have targets in that area, and you can have a little bit of what I call progress decay. In other words, you're not going up, you're either going sideways or a little bit down, and time is elapsing. It's a decay process without necessarily making big green. Remember, the surges tend to come in quite short time frames. You build up and then you run. You've had a sustained period of run now for quite a while. You built up from that point till you triggered there. There was nothing much going on. There was ups and downs and ups and downs. And in fairness to this further period over here, there was an immense amount of ups and downs for an extended period. Time-wise, you would categorize that as progress decay. In fact, that was a full pullback. Many people refer to it as a bear market. I don't actually agree. A full-blown bear market. There was a head and shoulders. You can see it from here. You can see your little right shoulder there, your bigger left, and your head over there right into the high. But the point being, you're in a macro bull for gold since way before, right down to the 250 mark. So if I pull this a little bit more through, we only got from 2007, so that's why we don't have enough history. But you know it from the dollar, that right down to 99, 2000, 2001, gold was probably at its most unappreciated there. So having run two macro targets in terms of the natural geometry, you could churn a little bit against the franc. That tells me the franc might be pretty strong during that period, because people need not only a reserve asset, gold, but they also need a transactional fiat for everyday living and expenditure. And for those of you that don't have a multi-currency account, we are excellent services. So remember, we build you wealth, we preserve and protect your wealth, and we get you optionality. Now, we have methodology and a number of options inside our community that is available to them that allows you to have foreign currency. So it's almost like you can choose to be sitting in francs for money that you need medium term for future expenditure that you don't want to tie up in gold. But you want to have not lose money and not lose buying power on the same scale that a dollar might in a contagion event, that a euro might if the dollar starts going up and the euro weakens, or in any other sense. So having a multi-currency based account could be very useful, and the Swiss franc could be a good hold. And that's what I would say. Maybe a little bit of churn winding up, but we will go again, and we will go higher in gold against the Swiss franc and every other fiat currency as well.
In the interview, FrancisHunt explains that recent geopolitical tensions triggered a short-lived spike in energy markets, which quickly reversed, highlighting the danger of overreacting to war news. Hunt isn't expecting a full-scale nuclear war, but rather a drawn-out, chaotic ceasefire. The American economy faces the unwelcome prospect of reignited inflation after the United States launched strikes on 3 nuclear facilities in Iran. It's unclear if any major spike in oil prices will be sustained for a long period. Oil prices have risen about 10% since Israel's surprise attack on June 13th, and then fell on Friday after US President Donald Trump announced a 2-week deadline on whether to strike Iran. One shouldn't necessarily assume that just because the price of oil goes up, it's going to stay there. It doesn't, said Joe Brusuelas, chief economist for the accounting firm RSM. Due to the growing global financial strain, FrancisHunt flags Japan's yen carry trade as a looming risk that could unravel with force. He foresees turbulent markets ahead and underscores the strategic importance of moving into safe haven assets like the Swiss franc and precious metals. Let's get back to the interview.
For those that are overzealous, the energies on account of war, it was a classic case of sell the spike high after the open. Let's just reduce some of that noise there a little bit and get it back down to a shorter time frame. You can see what transpired. We had a big red candle today. Let's take it to the 2-hour, and you can see how you gapped open and you traded all the way down. So the Swiss franc also had a gap, maybe not as big, 73 to 76, $3. What percent is that? $3 on 73. Probably around 4%, but you've given it all back. So trading for World War III. I'm not in the World War III camp, by the way. I'm not in the major nuclear conflict camp. I'm in the camp that they're going to throw stones at each other for a while until they kind of get a bit exhausted from it, and then they have a messy, okay, we'll cease fire for a while. I don't see them loving each other. I don't see peace being made. I see a disorderly cessation for a while until more global angst, warfare and warmongery brought to you by the hyenas of society end up coming again. But as you can see, far better to have been in the Swiss franc from the previous week, captured the run-up and be making new highs. Yes, there's been a small pullback by the end of the day, but you are substantially up than, for example, trading long the oil market. There was your gap, and you can see that you've held on to most of what happened after the gap up. Small dot back, beautiful candles all the way up, and your first rejection after running almost the 181. Okay, so that's your update on the Swiss franc, Japanese yen. A little bit of story time with Uncle Frank as to why the yen would probably be weaker. For the time frame under review, larger time frame, actually the yen could become a real problem and we could go into carry trade. So again, go and look at that USD JPY chart. Rally for a bit, give us our M head with the 2 shoulders, of moderate symmetry, and we could be in for a nasty reversal. That could be real contagion. That could affect risk on, that could affect crypto, equities, and a lot of other things if it starts to unwind. So the money would have to come out of the casino in America from the money production warehouse, the cheap money production warehouse in Japan. So there's like a conveyor belt going between them. Here's cheap money, here's the casino, here's some more cheap money, go to the casino, make yield, make free yield. Okay, that game could be coming to an end, and that affects hedge funds, institutions, and banks far more than it would affect us, apart from the fact that it will create great volatility, violent cuts in margin, potential counterparty risk on banks and brokers, and a very disorderly descent in the stock market that you who haven't got cheap yen to speculate in the stock market will still feel in the down leg. Okay, thanks for checking in. Remember, Tickmill trading through TradingView. Awesome, high leverage. Scandinavian capital markets, part of the larger Europe, and very, very sound broker, but outside of the margin restrictions. They both offer platinum and the Swiss franc JPY. And then, of course, I also use crypto sometimes when the crypto markets are dull and not looking particularly interesting. That is a simple FX, and you can put crypto in there, you can put in normal fiat in there, you can put in tethers, you can put in Bitcoin, and then you can also trade platinum and, of course, Swiss franc JPY. Okay, great to be with you guys. Thanks for watching. Hit the like and the share. Book a call if you want to be making great profits out of that. Sometimes people say, oh, there's always that thing about trading. And I always have mixed feelings about showing P&Ls. But we've got accounts that are absolutely singing now in terms of the platinum move and the Swiss franc Japanese yen move, which have been substantial. And I don't tend to want to put those up. You either believe me or you don't. But you are missing out by not starting today. There's a lot of people that sit on YouTube, I'm reverse engineering, I'm doing this. No, it's all the trades you're missing. It's all the accelerated learning through experience with others you're missing. It's the finer detail that you're missing. I love to be able to give stuff free on YouTube and to help people along, and we even give you access to some of our trades a little bit later after our communities had first hits at them, in the hope that some of you, and we've had people have traded their way into our community. So great, all of those things. Remember, it is non-advisory. This is me talking about what I think is going on in the market and how we are choosing to represent that.
The key drivers of gold include central bank accumulation, geopolitical risk, potential Fed rate cuts, and structural shifts in global capital flows. Even JP Morgan has predicted that gold may reach $6,000 per ounce in 2029, which is an 80% jump from the current price, according to the report. As central banks respond to mounting crises and capital continues to seek refuge, do you believe gold is emerging as the only true safe haven in an increasingly unstable financial world? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.